Hi and Assalamualaikum. Today my group members and I will present to you about why management accounting rise and fall. Firstly, management accounting reports are of little help to operating managers attempting to reduce costs plus improve productivity, since the report decrease productivity because they require operating managers to spend time trying to understand and explain reported variance that not related to the economic and technological reality of their operations. The system fails to provide relevant information to managers, and the system distracts the managers from noticing the key factors important for production efficiencies. The management accounting system fails to provide accurate product costs. For example, misguided decision on product pricing, product sourcing, product mix, and responses to rivals' product. Many firms seem to be falling victim to this trap. The financial accounting system management treats many cash outlays as expenses of the period which only will benefit the future. For example, managers tend to be under pressure to meet short-term goals. Today's management accounting system provides a misleading target for managerial attention. They fail to provide the relevant set of measures that reflect the technology, product, process, plus competitive environment. For example, financial managers get isolated from the real value, creating operations of the organizations, and fail to recognize the relevant or appropriate measures of the organization's operations. The next one is the opportunity. In the article, mostly it is about what is happening right now in our modern time. They suggest that digital computers information can be recorded in real time for analysis operating performance. Automated part recognition and tracking systems combined with local area network technology can provide continual status reports on work in process. This is happening right now as we have our cell phones, computers, and we can monitor all the data online. Timely and relevant managerial performance measures can be computed and disseminated throughout the organization. Today's designer of management accounting system can use sophisticated electronic technology to devise reporting and control systems. It is more accurate, more timely, more effective than those designed by their predecessors. Also, this is too costly or even infeasible, no longer needed to be tolerated. As for the challenges in the article, it is stated that an organization management accounting system must provide timely and accurate information to facilitate efforts to control costs, to measure and improve productivity, and to devise improved production process. The management accounting system also needs to report accurate product costs so that pricing decisions, introduction of new products, abandonments of obsolete products, and responses to the appearance of rival products can be made with the best possible information on product resource demands. Finally, large decentralized organizations require systems to motivate and evaluate the performance of their managers. The organization management accounting systems serve as a vital two-way communication link between senior and subordinate manager. The goals and objective of the organization is the management accounting system is the channel by which information about the firm's product performance and production efficiencies get reported to upper levels of management. Success depends on production and distribution systems for these products and on effective marketing efforts. When managers understand the irrelevant personalized information system, but danger lurks if managers do not recognize the inadequacies in their management accounting system and erroneously rely on it for managerial control information and product decisions.
Next, the management accounting roots. During the 19th century, almost all exchange transactions between the owner or entrepreneur and those who were not members of organization, such as raw material suppliers and piecework labor. The transaction has took place in the market, and success indicators were simple to come by. The owner or entrepreneur needed to collect more cash from sales to customer that was paid out to suppliers of the input factor of production, primarily labor and material. As a result of Industrial Revolution, it became more cost-effective for 19th century business owners to invest a large sums of money in their manufacturing operation. So, rather than enduring the costs and hazards of continuous void contracting in the labour market, the owner has recruited personnel on a long-term basis to maximize the efficiency of their capital investment. The early management accounting method was straightforward, yet they appear to meet the needs of owners and managers. They concentrate on conversion costs and came up with summary metrics like cost per hour. The labor and material costs were included in the conclusion, as well as some attribution of overhead costs. Next, the great advancements in the transportation and communication, particularly the creation of the railroad and telegraph, create further chance for massive enterprises by the middle of the 19th century. These businesses could now coordinate the acquisition of raw materials and the transportation of finished goods across considerably broader geographical areas than before. The railroad corporations of the mid-19th century has provided some of the best examples of successful management accounting system. The new procedures were created especially to oversee the receipt and investment of funds to oversee their diversified and distant operations. For each key part of operation, the measurements such as cost per ton mile were devised and reported. The operating ratio was created to assess the profitability of various company segments. It required data on the effectiveness and efficiency of retail store chains like Marshall Field's purchasing, pricing, and retailing activities. It was produced measures such as gross margin and inventory stock return for these activities. These examples show how management accounting information was created to help process-oriented businesses such as transportation and distribution manage their operations more efficiently. The goals of the measures were to encourage employees and assess the efficiency of the internal operations. As a result, the management accounting system was developed to improve efficiency in the organization's essential operations activities. To support the expansion of multi-activity, diversified organization, the final innovations in management accounting systems happened in the early decades of the 20th century. Companies' executives were faced the challenge of coordinating the various activities of a vertically integrated manufacturing and marketing organization, as well as deciding on the most lucrative capital allocation of these various activities. The return on investment, which is ROI measures, was the most important and long-lasting management accounting invention. It gave an overall indicator of each operating units and the entire organization commercial success. The Chief Financial Officer of DuPont Company, Donaldson Brown, has broke down the ROI measure into its constituent elements and showed that it could be seen as a combination of two efficiency measures, operating ratio and stock turn. The division managers were in charge of their division's profitability and return on capital, as well as their potential to produce more capital requests. Thus, the central managers were now in the position of providing capital to diverse operating units and attempting to coordinate, motivate, and evaluate the performance of their divisional managers. The ROI measures play a key role in promoting this internal market for managers and for capital to function.
In the year of 1925, the management accounting practices has developed so much in so many fields, such as cost account for labor, material and overhead, budget for cash, income and capital. All of these practices had been evolved to serve the informational and control needs of the managers. But however, in the middle of the year of 1920s, the innovation has stopped to occur as there is a little incentive to continue the development in the innovation of the management accounting practices. Even though there is no innovation occurred, but the diversity of products and technologies is increasingly progressed along with the size of the company and the corporation. Therefore, the accurate product cost and effective control process is very needed in order to get in line with the progress of the technologies and the diversity of products. This has led to several of today's problems, such as distorted product costs, delayed and overly aggregated process control information, and the short-term performance measure doesn't reflect back with the company economic position. In that year, it is not relevant because there is a dominance of external and financial reporting. This is because there is so many company and organization that want to become a public corporation. Therefore, they are more focused in doing an audited financial statement. This has led to the organization doesn't see the needs and the importance on having a good management accounting system. In this article, the writer has stated that they blame university-based researchers for fail to notice the growing obsolescence of the organization management system, and they also fail to improve the system. They also say that the academic are led astray as they too narrowly focus on a simplified model of firm behavior, and they also blame the way researchers do their work as they do not experiment it on the actual organization environment, which means they do not implement their idea on the real world. There are also many companies that do not care about the management accounting system as they believe in the company's numbers, which means if the company has higher profit, then they do not see the needs or the importance of having the good and relevant management accounting system.
Next, accounting for caravan. In some ways, this isn't a brand new phenomenon. We might question what types of events occurred in the 15th century that lead to a need for accounting information if we go back to the publishing of arguably the first accounting book by Fra Pacchioli. Venetian merchants were undoubtedly involved in international trade. Consider a group of Venetian investors who bought products made in northern Italy and chartered an expedition to sell them in India. The traders bought tea, returned to Venice, and then sold it. The accountant calculated a profit for the entire voyage by subtracting the cost of the caravan and the cost of purchasing the first lot of products from the income collected from the sale of tea in Italy. A profit that would be split among the venture's investors. Accounting's function is to calculate the venture's overall profitability and distribute the net proceeds to the founding investors. The fact that we believe it is pointless to apportion project profitability to short-term time periods during the project's life cycle does not mean we believe it is pointless to try to gather useful indicators of short-term development. Returning to our Venetian mission, the investors would most likely be interested in learning about the caravan's performance in the third quarter of 1487. For example, what distance did the caravan cover and in what direction? Or how many provisions are left? What is the condition of the inventory being transported? Or are the workers content or rebellious? There are numerous indicators of the caravan manager's success in the third quarter of 1487 that could be relevant. Quarterly profit, however, are not one of them. And in today's competitive technology economy, quarterly earnings are probably not the best predictor of a company's short-term performance. Cash flow is unquestionably vital, and we like to understand the pattern and the structure of a company's cash revenues and cash expenditures. However, understanding cash sources and uses is not the same as working diligently every month and quarter to prepare entire income statements and balance sheets, complete with amortization, capitalization, and a slew of other accruals. The challenge and opportunity for contemporary organization is clear. Management accounting systems may and should be developed to support an organization's operations and strategy. Technology exists to implement systems that are vastly different from those already in use. Knowledge is what is lacking now. Experimentation and communication, on the other hand, can lead to this knowledge. Creative managers and academic researchers committed to developing new concepts for designing applicable management accounting systems can revive the innovative spirit of 100 years ago at the start of the scientific management movement. Last but not least, management accounting used to be centered on a static environment, but in today's economy, demands and markets as well as the evaluation of performance are continually changing. In order to be successful, a company must be able to adapt its strategy to changing constraints. Management accounting is used to stimulate employee creativity so that they can think outside the box about how to meet their organization's goal in the face of changing market conditions. Management accounting is a forerunner in the accounting industry standard. Textile and railroads company were among the first to embrace it. However, it has grown less relevant due to factors such as inaccuracy and difficulty. Fast forward to now, and we can see that management accounting is more crucial to internal financial reporting than official financial reporting. Both have their advantage and advantages. Researchers are currently working to develop improved management accounting concepts in order to establish its relevance.